right, so right now, somewhere in the world, a trader is watching a losing position and telling themselves it'll come back. Maybe that trader is you. Maybe it was you last Wednesday when the Fed turned hawkish, the S&P dropped over 1%, and anyone who bought the record high the day before got absolutely caught. Here's the uncomfortable truth most trading channels won't say out loud. Every trader loses. The best traders in the world win maybe half their trades. The entire difference between traders who can survive and traders who blow up isn't the win rate, it's actually what they do with the losers. A losing trade managed with rules costs you a small, survivable amount. The same losing trade managed with hope and improvisation is what ends accounts. My name is Pablo, this is the Research Desk, where every claim is cited, every strategy includes its failure conditions, and there's zero hype. If you're new here, welcome. If you've been here before, let's get into it. Start with the math, because once you see this, everything else makes sense. Losses and the gains needed to recover them are not symmetrical. That's the part most beginners never learn. Lose 10%, for example, you need an 11% gain to get back to even. Annoying but manageable. Lose 25% and you need a 33% gain just to recover. Lose 50% and you now need a 100% gain just to break even. You have to double what's left. Lose 75%, you need a 300% return to get back to where you started. You need to quadruple the remainder at that point. The relationship is exponential, not linear. And that single fact is the entire argument for cutting losses early. The deeper the hole, the mathematically harder it becomes to climb out. Small losses are survivable, large ones are not. They trap you in a recovery math problem that most retail accounts never solve. So, how do you make sure your losses stay small? Here's the most important habit in trading, and it happens before you ever place a trade. You decide in advance the exact price where you'll admit you're wrong. That's your stop loss. And the reason it must be said before you enter is simple. The moment you're in a losing position, your judgment is compromised. Hope, fear, the sting of being wrong are all working against you. A decision made calmly at entry is worth 10 decisions made in the heat of a drawdown. Where you place it matters. It should be based on the chart and your strategy, not on a dollar amount you're emotionally comfortable losing. Some common defensible methods include just beyond a clear support or resistance level, below a recent swing low, or a set multiple of the asset's average daily range so normal volatility doesn't stop you out. Here's the rule. Write it down before you click buy. Note 3 numbers: your entry, your stop, where the thesis is wrong, and your target. If you can't define or you'd be wrong, you don't have a trade, you just have hope. Not every red position is the same, and knowing the difference is what separates a disciplined exit from a panicked one. There are 2 distinct situations. They call for opposite responses. Situation 1, normal noise. The trade is down, but nothing about your original reason for entering has changed. Price is wiggling within the range you expected. Your stop hasn't been hit. Your thesis is intact. The correct move here is usually to do nothing. Let the trade work. Reacting to every tick is how you stop yourself out of trades that would have won. Situation number 2, broken thesis. The reason you entered no longer holds. The level you were trading broke. The catalyst failed and the macro picture flipped. The way a hawkish Fed surprise can invalidate a bullish equity setup in a single afternoon. When the thesis is broken, you don't wait for the stop, you exit immediately. The trade no longer has a reason to exit. Here's the honest test. Ask yourself, if I had no position right now, would I enter this trade today at this price? If the answer is no, you're holding out hope, not analysis. That's your signal to get out. Now here's the one that ends accounts. Read this carefully. Price approaches your stop. The loss suddenly feels real, and a voice says, I'll just move the stop a little lower to give the trade more room to breathe. The moment you do that, you have abandoned the entire purpose of having a stop. You've converted a small pre-planned survivable loss into an open-ended one with no floor. And the trader who moves a stop once almost always moves it again. and again, writing a position all the way down while the loss compounds into the exponential zone we covered in the math. The pre-commitment you made at entry with a clear head was the correct decision. The urge to override it mid-trade is precisely the emotional impulse the stop existed to protect you from. Stops move in exactly in one direction, in your favor. As a trade works and builds profit, trailing your stop to lock in gains is sound risk management. Moving it away from price to avoid a loss is not risk management, it is a risk denial. A stop loss you move is not a stop loss, it's a wish, now with a worse exit price. Averaging down means buying more of a position that's already losing. It is one of the most dangerous things a trader can do, and in a narrow set of circumstances, a legitimate strategy. The difference is entirely about whether it was planned. The trap looks like this. You're down, it hurts, and you buy more to lower your average so a smaller bounce gets you back to even. This is an emotional decision dressed up as a strategy. You are adding risk to a position that's already proving you wrong. If it keeps falling, your losses now compound to a bigger position. This is the classic account killer. The legitimate version of this looks like this: a pre-planned, scaled entry where you decided before entering to build the position in tranches at specific levels, with a hard stop below the lowest one, and a position size that accounts for the full intended position from the start. The distinction isn't the action, it's whether the plan existed before the emotion did. If you're deciding to average down because you're losing, it is a trap. Full stop. Everything we've covered so far gets dramatically easier with one adjustment: correct position sizing. Because the real protection against blowing up isn't any single stop, it's making sure no single trade can hurt you much. The widely used guideline: risk no more than 1 to 2% of your account on any one trade. Risk here means the distance from your entry to your stop, multiplied by your position size. Work it backwards. Decide the dollar amount you're willing to lose. Say 1% of $10,000 account is $100. Measure the distance to your stop. Let the math determine how many shares or contracts you buy, not the other way around. Sizing this way, hitting a stop is a non-event. You could be wrong 10 trades in a row and still have most of your account intact, ready to trade. That is what survival looks like. There is a well-documented behavioral bias behind almost every blown account. It's called the disposition effect. It's a tendency to sell winners too early and hold losers too long. We do it because realizing a loss means admitting we were wrong. And the mind would rather hold a paper loss that still feels reversible than lock in the sting of a real one. The market does not care about your feelings, and a paper loss spins exactly like a real one. The defense is mechanical, not emotional. You cannot out-willpower a bias this deep in the moment. So you remove the moment from the equation. Set the stop at entry, size to 1 to 2%. Write the plan down. Then your job during a losing trade isn't to decide anything. It's just to follow the rules you already made when you were thinking clearly. The discipline isn't in the drawdown, it's in the preparation that made the drawdown a non-decision. Here's a checklist. 4 questions. Run them the next time you're holding a losing trade. Question number 1. Is my stop hit, or is this just noise? If the stop is hit, you're already out. That is the entire point of the stop. Question number 2. Is my original thesis still true? If no, exit. Don't wait for the stop. Question number 3. Am I tempted to move the stop or average down on hope? That urge is the signal to do the opposite. Last but not least, question 4. Was this position size to the 1 to 2% rule? If yes, the loss is survivable. Let the process work for you. There you go. 4 questions, 60 seconds. That checklist has saved more accounts than any indicator, any strategy, or any trading course ever will. Tell me in the comments, guys, which of these 4 mistakes have you made? Maybe moving a stop, maybe averaging down on hope, holding a broken thesis, or maybe sizing too big. I've made a good, or maybe all 4 of these mistakes in the past. Most traders have. The difference is whether you build the rules after. Learn from your mistakes. If this gave you an edge today, smash that like and subscribe button for weekly market research. It's free every week. There's YouTube, of course. Until next time, trade smart, stay curious, and keep your emotions out of your portfolio. Thanks for watching and see you on the next one, guys.